Something is changing beneath the surface of the global financial system, and almost no one is talking about it. There are no breaking news banners, no emergency press conferences, no dramatic price spikes on your screen. But if you look at behavior instead of headlines, if you follow what institutions are quietly doing instead of what they are loudly saying, a pattern starts to emerge. Banks are preparing for something in the silver market, not trading it, not promoting it, preparing for it. And when banks prepare instead of speculate, it means they see stress coming before everyone else does. This is how every commodity shock in modern history begins. Not with panic, but with silence. Not with price explosions, but with accumulation. And silver right now is exhibiting the same early signals that oil showed before 1973, rare earths before 2010, and semiconductors before 2021. By the time the public noticed, supply was already locked up, and prices were no longer negotiable. What we are witnessing today is the formation of a silver tsunami, a slow buildup of pressure that looks harmless on the surface, but once it breaks, it changes the entire shoreline. To understand why banks are preparing, we need to understand what silver has quietly become. For decades, silver was treated as a speculative metal, overshadowed by gold and dismissed as volatile and inefficient. But the world that treated silver as a minor asset no longer exists. Modern civilization now depends on silver in a way no previous era ever did. Every solar panel, every electric vehicle, every data center, every missile guidance system, every advanced medical device relies on silver's unmatched conductivity and reliability. And unlike oil, unlike copper, unlike silicon, silver has no functional substitute at scale. At the same time, demand has structurally exploded, supply has done the opposite. Global silver production has barely grown in over a decade, and more than 70% of silver is not mined directly. It's a byproduct of copper, zinc, and lead mining. That single fact changes everything, because it means silver supply does not respond to silver prices. Even if silver doubles or triples, miners cannot suddenly produce more unless base metal economics also justify expansion. This creates a dangerous imbalance. Inelastic supply meeting mandated demand. Mandated is the key word. Governments around the world have committed trillions of dollars to electrification, renewable energy, digital infrastructure, and military modernization. These are not consumer preferences that disappear during recessions. They are policy commitments written into law. Solar installations must double. Grid systems must expand. Defense stockpiles must grow. And silver sits at the center of all of it. This is why banks are paying attention. Not because silver is fashionable, but because silver is critical. Now here's where the story becomes uncomfortable. The silver market that most people think exists is largely an illusion. The majority of silver traded every day isn't metal at all. It's paper contracts, derivatives, ETFs, and unallocated claims that assume the metal exists somewhere else. For every single ounce of physical silver available, there are dozens, sometimes hundreds, of claims written against it. That system works only under one condition, that most participants never ask for delivery. Banks understand this better than anyone. They helped design this structure. And they also understand exactly when it begins to fail. Watch what happens when a market moves from abundance to strategic importance. Institutions stop providing liquidity. They stop selling inventory. They pull assets inward. They move metal from registered, deliverable categories into private custody. They convert optional supply into controlled supply. This is not manipulation, it is preparation. Over the past several years, physical silver inventories at major exchanges have steadily declined. Not dramatically, not suddenly, quietly. And each time inventories drop, prices remain calm, sending a false signal to the public that nothing is wrong. But price lags reality. Availability always moves first. At the same time, industrial buyers have changed behavior. Instead of sourcing silver on spot markets, they are locking in long-term supply agreements directly with producers. This bypasses exchanges entirely. When manufacturers remove demand from public markets and replace it with private contracts, liquidity disappears without headlines. Banks see this contraction early. Retail investors feel it later through premiums, delays, and out-of-stock signs. This is the first wave of the tsunami. The second wave is geopolitical. Silver is no longer just an industrial input. It is becoming a strategic material. Countries that learned hard lessons from past supply chain shocks are quietly securing access. Export controls, regulatory friction, and domestic stockpiling don't begin with announcements. They begin with classification. When a resource is reclassified as strategic, transparency declines, data becomes less reliable, and markets become less efficient. Banks operate at the intersection of governments, corporations, and markets. They see capital flows, custody movements, and cross-border settlements in real time. And when they start holding rather than facilitating, it means they expect fragmentation. It means they expect a future where silver is not freely available to everyone at the same price. This is not unprecedented. In every major resource crisis, the same sequence plays out. First, smart money secures supply. Then paper markets begin to diverge from physical reality. Finally, rules change. When rules change, paper holders lose optionality, physical holders gain leverage. This brings us to the most dangerous misconception in the silver market, the belief that price equals access. It does not. In stressed environments, price becomes irrelevant. You can't buy what isn't for sale. History is full of examples where contracts were honored in cash instead of delivery, not because of malice, but because the metal simply wasn't there. Banks remember this. They remember when markets forced cash settlement. They remember when exchanges rewrote rules to protect the system. And they remember exactly which assets survived those moments intact. Silver survived every time. Not paper silver, but physical silver. Now imagine a future shock. It doesn't need to be dramatic. A regional conflict that disrupts mining logistics. A sudden spike in military demand. A regulatory shift that prioritizes domestic supply. Or even a public acknowledgement from a major manufacturer that silver sourcing has become unreliable. Any one of these events would be enough to trigger panic, not among retail investors, but among institutions that require silver to function. Once that panic begins, the scramble is not for profits. It is for continuity. Who gets supply? Who doesn't? Who pays premiums? Who waits? Well, banks are preparing for this exact environment. They are positioning to benefit from volatility, yes, but more importantly, they are positioning to survive a system where paper claims face scrutiny, where counterparties matter again, where trust evaporates quickly. This is why the silver tsunami metaphor matters. A tsunami is not a sudden wave. It is energy transferring invisibly across vast distances, growing power without surface disruption. The ocean can look calm minutes before devastation. The warning signs are subtle. Receding water, strange currents, unexplained silence. Silver's warning signs are inventory drains, custody shifts, long-term contracts, and strategic classification. None of these move prices immediately. All of them change the future. So why hasn't silver already exploded? Because this is still the preparation phase. The phase banks value most. Once the tsunami breaks, opportunity disappears. Preparation turns into defense. The final phase always looks the same. Realization. When the public realizes that silver is no longer abundant, that spot prices don't reflect deliverable supply, that ETFs do not guarantee metal, behavior changes instantly. Demand shifts from paper to physical. Premiums detach. Liquidity evaporates. And price begins to move violently, not because of speculation, but because the system is repricing reality. Banks don't wait for that moment. They move before it. This is why the question isn't whether silver will move. The question is who will be positioned when it does. History shows that those who recognize structural shifts early don't just protect themselves. They define the next phase of the market. The silver tsunami is forming. Banks can see it because they sit closest to the fault lines. Everyone else will see it when the water pulls back. And by then, there will be no time left to prepare. Thanks for watching. If you found this valuable, please subscribe and share your thoughts in the comments.